perfect setup for Ken Shinoda, portfolio manager over at DoubleLine Capital. Hey, Ken, that was a great setup from Scarlett, right? Was this more hawkish or just more dovish? Or not as hawkish, but more dovish? Does it matter?
This was definitely more dovish than I think the market expected. One of the risks going into today was that Powell came out a little bit hawkish, talking about how inflation was higher than he wanted, and maybe they would need to get more aggressive. But he was nowhere close to that. He seems very confident, almost too confident, in the fact that inflation will come down through the end of the year. However, very recently, over the last couple of months, we've seen inflation prints come in higher than they would like, and so we're staying higher for longer, which is where we are today with Fed funds.
From where you sit, Ken, what is the right inflation target for our current economy that's going through, still recovering basically from the fundamental supply side changes and had been performing much better than anyone anticipated, even as it shows signs of losing a little bit of that momentum?
Well, I think the bigger question is what's the inflation rate the Fed wants, because that's how their policy is going to be until they get to their goal, which is 2%, and they're getting there, but inflation's starting to move sideways. Some of the problems they're running into is that the stickier parts of inflation, one being the housing component or shelter component, works with a lag. And while we're seeing multifamily offering rents coming down meaningfully, it's taking longer to come through that part of inflation. The other sticky part of inflation is services, and that's really correlated with the job market and wages. And the job market, as we see with unemployment, has remained very, very strong. The couple good signs that we have seen very recently is that the quits rate, and Powell mentioned that today, has continued to decline. The JOLTS, or job openings, has continued to decline. So these are signs in the background that the labor market's getting cooler, but the economy still seems to be going okay, and that's bad for inflation.
That gets to a question, though, Ken. I mean, where is the balance? I mean, when you listen to Jay Powell today, he seems to be kind of holding out hope, at least publicly, making it clear he's holding out hope for that soft landing scenario here. Are we not at least in that realm of a soft landing, or is that sort of a past?
Currently, I think we're in that realm based on the economic data. The challenge will be the higher inflation stays kind of up where it is and moves sideways, the higher we'll have to keep rates, which will eventually start to sting the economy more. Certain parts of the market are affected more by the rise in short-term rates. Floating rate markets, companies that have to borrow in the bank loan market, commercial real estate loans. We're already seeing trouble in commercial real estate. So as time passes and short-term rates stay higher, that's going to start stinging parts of the economy.
Do I buy Treasuries right now, and where on the curve?
The short end of the curve, I think, looks pretty good. The 2-year is almost up to where short-term bills are, and it was much lower before. I kind of like the 10-year as we got up towards 470. I thought we might break up towards 5% if we got some more positive economic data and higher inflation. That's still probable. That could happen in the next coming months as we get more data. But I think Powell's dovish stance today is going to keep Treasuries in the trading range that it's been in over the last couple of weeks and months.
How about credit? Where do I want to be with that, especially with spreads pretty tight?
The credit spreads have been tightening and the credit curve has been flattening, meaning the difference between the high quality credit spreads and the riskier stuff has been compressing. So we like a mix of kind of high quality credit with the top part of the below investment grade market. I think credit's BB up to AA, especially at the front of the yield curve. You can find some 7 to 7.5% type yields without taking much risk, not taking much duration risk, and we're pretty comfortable with that, and that looks pretty attractive in today's environment.
We're in conversation here with Ken Shinoda over at DoubleLine. I just want to also bring this attention to our viewers here. You take a look at that chart there. That's dollar yen. You see a huge spike down on that chart. That's a strengthening of the yen that has occurred really 1, 2, 3, and basically the past 4 minutes or so. So a 1% move, 1% strengthening in the yen versus the dollar in just the past 3 minutes or so. Obviously, a lot of speculation as to exactly what's happening there. Scarlett?
Yeah, no, it's unusual that it would happen at this time of day, too, because the currency market is not active at the end of U.S. trading. I mean, you would see it maybe during London trading, but certainly not at the end of the U.S. trading day.
Yeah, but you're looking at just a weaker dollar in general.
So, Ken, I want to pose this to you here. I mean, I know we kind of brought you on to talk about the Fed and stuff, but I'm sure you've had your eye here on some of these FX moves, particularly when it comes to dollar-yen. And this is now the second time this week we've seen a huge spike in such a short period of time. And I know we don't know for sure who's behind this here, but what do you make of it?
Well, it's all about what the Japan is doing with their interest rates and how much lower they are than the rest of the world. And we raised rates across the globe, and they're still sitting near zero. And it's been a constant deterioration in yen valuation. And I think there's starting to be some intervention that happens to try to stabilize their currency.
But it brings up another question, though, Ken, about the rate differentials out there. I mean, there were a lot of people when they were looking at the weakening of the yen, at least prior to this week, saying a lot of that had to do with the widening gulf between monetary policy overseas and monetary policy here. Based on what we know now about how Jay Powell is thinking, the idea that hikes at least appear to be off the table doesn't necessarily mean we're going to cut. Are those differentials still going to stay as wide as they are? Or are we going to see some of the other central banks move?
I think it helps stabilize some of the other currencies that we're not going to hike here. You've actually had a great run in some of the emerging market currencies. Emerging market bonds have been some of the best performing parts of the sovereign markets. So I think the Fed staying on hold here will help bring some stabilization in other parts of the globe.
If the Japanese authorities were behind this sudden yen strength, what do you think they heard from Jay Powell, from the Federal Reserve today, that might have prompted them to intervene?
That he's not going to, he really doesn't want to raise rates. He doesn't think we're anywhere close to having to raise rates again. And just the stability of the Fed's policy, I think, it got them to act, perhaps.
Before we let you go, Ken, let's push ahead to Friday. Is it going to be about inflation or is it going to be about jobs? What's going to be the key for you now as you're looking at the bond market and the next trigger?
It's both. That's their policy needs to keep employment stable and keep prices at bay. And we need to see inflation come down. And to do that, we may need to see unemployment go up a little bit. So we need to keep our eyes on both those metrics in the next couple of months.
All right, Ken, always love talking to you. We'll talk again soon. Ken Shinoda over at DoubleLine Capital.